Give us 30 minutes each week to discover the trends that are shaping the future of retirement with That Annuity Show. We bring you conversations with industry leaders who are revolutionizing financial products, technology, and distribution channels. Now, here's your host, Paul Tyler.
Okay, hi everybody, and welcome to the latest episode of That Annuity Show. Very excited to be here today. I'm Ramsey Smith. I am an entrepreneur and a board member of a large life insurance company. My company is called Alex Income, and for those of you who can see the video, I have a nameplate on my microphone for the first time. So I appreciate any feedback on what people think of our artwork so far. Joined today by my colleague Bruno Karen, fellow co-host of the show. Hi, Bruno.
Hi, Ramsey.
Great to see you. So our lead host, Paul Tyler, couldn't make it today. So I'm going to do my best. And thankfully, I'm here with Bruno, who's been fantastic partner on the show for I think a couple of years now. So this is going to be great. But the most important part of the show is our guest of honor, and that is Bill Bengen, who in my view is one of a handful of really sort of I'll call them OGs, right, in the personal finance space over the course of the last 25 or 30 years. Bill Bengen is the creator of the 4% rule. And so we're going to talk a little bit about what that is, even though I think many people on the show probably are already quite familiar with the 4% rule. And we'll find out, what led Bill to, one, come up with this really important seminal idea. Two, what still keeps him going, because Bill's clearly not going to retire anytime soon. And three, quite importantly, Bill has a book coming out in August of 2025, which is going to be a follow-on, a chapter 2 of the 4% rule, and I think is going to be very exciting. So, Bill, welcome back to the show. It's been too long, and we're very excited to have you.
Thanks. I appreciate the invite back. It's great to be here.
So, Bill, why don't we jump right into it? So, the 4% rule is a principle that it finds itself in so many conversations in the personal finance industry. Financial advisors all over the country, maybe the world, but certainly all over the country, use this as a sort of initial guiding principle to help people figure out how they take the value in their account and they use it judiciously enough that it will last for a lifetime. Like, when did you initially create the 4% rule, and what was the impetus for you doing that?
Yeah, that takes me back a few years. I wrote my first paper in 1994. I was a pretty wet behind the ears financial advisor. I've only been in business for a few years. But I was fielding these questions from clients about retirement and, what they could spend. So I started doing my own research, and I decided I had some initial findings. I presented them in a paper. It's a very, very simple thing that I did. I basically looked at individuals that retired from 1926 to date, which there's a lot more today than there were back then. I was trying to pinpoint basically the one retiree who had the worst experience and had the lowest withdrawal rate. So I could kind of establish that as a standard for folks to look at. It turned out that the retiree in October of 68 could only take out, and my number was 4.15% in that paper. And that money would last 30 years, assuming it was taken from a tax-deferred account like an IRA. And, I never used the word rule in that paper. I never intended that that number would be applied to everybody. I was looking for a worst-case scenario, essentially, and I found it. But somehow, after the paper got published, I started hearing about the 4% rule and, simplification of the result and applying it very, very broadly to everybody, which, it's important to understand. It's a worst case and applies to a very, very small percentage of retirees. But, it is what it is.
Got it. Okay. All right. Can you give a quick overview of what exactly the 4% rule is? And the reason I'm asking is we once had Moshe Milevsky on. This is episode 75.
Sharp
I think
guy.
I think we're close to 275 now, if you can believe it. So
amazing.
This was quite a few years ago. and we started talking about the 4% rule, and he asked us what the 4% rule was. And I think we probably had 4 or 5 hosts on that day, and we all came up with a slightly different answer.
Uh-huh.
So I want to make sure that we're clear on what your version of the 4% rule is, right? So exactly how that benchmark works.
Yeah, I'll tell you what I intended it to be. Basically, it was withdrawing from your portfolio, much like Social Security works. You start out the first year, you take 4%. If you have $1 million in your IRA, that would be $40,000. And the second year, you forget about the 4% completely. You just throw that number away and forget about it for the rest of retirement. And you just simply increase your withdrawal by the amount of inflation the year before. So the idea of this kind of withdrawal scheme is to keep your income pace with inflation and maintain your lifestyle. And that's the mechanics of it, essentially.
Got it. Perfect. So Bruno, Bill, you may not know, but Bruno wrote a book called Retire with Strength. Bruno is a fellow advocate of retirement income, like all of us on this show are. And so, Bruno, very curious to hear your thoughts on what we've heard so far, or any particular questions.
Well, I think we're just at the beginning right now, so really looking forward to hear more. And so thanks for setting the stage. And to Ramsey's point, I think everyone has their own definition or their own view on what the 4% rule is or should be. So I think we've set that up. Now I want to change gear here, and you mentioned you have a book that's coming up. That's kind of taking the basic foundation of the 4% rule and basically adapting it, if I understood that correctly, but adapting it in more of the today's environment. And I think that the actual word is supercharging the 4% rule.
There we go.
So my question is, what is the intent of the book? What is what? Obviously, a lot of things changed from your original publishing of the 4% rule and this book. What are your goals, and what are the kind of the main topics of this new book that is coming up this summer?
Sure. I think you can think of the book as kind of like a cookbook, which gives you a recipe for creating your own personal retirement withdrawal plan. It's not just about a number. There's a lot of things that go into it to determine, what your withdrawal rate will be and how you're going to withdraw the money. I wrote a book back in 2006, and it took me 18 years, I guess, to write another one because there was a huge gap in the process to develop a plan. I found there was no way for which I could determine scientifically how to recommend people withdrawal rates higher, let's say, than the 4%. I knew that historically, most retirees could take more, some a lot more. In fact, if you look at the average over the last 100 years, the average is about 7%. So, it would be shocking to some folks because they're thinking about 4%, and all of a sudden, wow, the average was 7%. And there are a lot of folks who could take out 8, 9, even as high as 16%, during the Great Depression. So, in 2021, I kind of stumbled upon a solution to the problem, and I found a way using inflation and stock market valuation to accurately determine what your withdrawal rate should be. And so you can now access these higher withdrawal rates. And once that piece fell in, I had a complete process. And the book basically sets out the process from soup to nuts, how to determine for yourself what your withdrawal plan rate should be. And equally important, once you get a plan in place, how you should manage it during retirement, because anybody knows a long-range plan doesn't run itself. You're going to encounter issues and situations you didn't anticipate when you went to retirement. So you have to be prepared to deal with those.
So not running out of money is clearly an objective.
Yeah.
But it's not the only objective. If I understand what you said correctly, there's a strategy behind it. You can always underspend to increase your probability of not running out of funds, but that's not necessarily the ideal outcome, the ideal strategy. Did I get that right?
Yeah, my goal all along has been to show people how to maximize their income from their investments, their retirement investments, without taking undue risks. That you got to have both those parts, and the book is all about that. You can underspend, but you have to ask yourself: you spent all those years working, all those years saving. Why not enjoy that money to the ultimate?
So in the book, you do talk about those 8 elements
Right.
of a comprehensive personal retirement withdrawal plan.
Uh-huh.
Can you elaborate and identify those 8 elements for us, please?
Yeah, would you like me to go through each of the 8 briefly?
Let's rock and roll, please.
With time for that? Okay,
Yeah,
good. The first one would be withdrawal scheme. What does that mean? Well, as we explained earlier, with the 4% rule, we use something similar to Social Security. I call it the COLA scheme, okay, where you basically start out with a certain percentage and then increase it for inflation each year. That's not the only way to withdraw money. There are lots of different ways. If you wanted to, you could take a fixed percentage of your assets each year and try to spend it that way, or what I call a fixed annuity approach. Basically, start with a fixed percentage and fixed dollar amount and make that go through, disregarding inflation. Another popular one I look in the book is what I want to call the cliff method, or basically a lot of folks during retirement want to spend more heavily in the early years and then cut back their spending later. And you have to really analyze that to see how much of a cutback is necessary. But that makes a lot of sense. I've analyzed that in the book as well, and a couple of others, and just an infinite variety. So the first thing you have to draw to customize your withdrawal plan is determine how you're going to withdraw your money. The second one would be how long you're planning for. 30 years, 35 years, 40 years. Some of the fire folks, they'll look at it maybe 50 years or more if they're retiring early enough. And the longer you plan for, the greater the effect will be on your withdrawal rates. So you have to determine your planning highs, and it's related to your life expectancy, but I don't recommend anybody plan to have their money run out with their last breath. That is just a tough call for all of us to make. I think you might want to take your life expectancy, let's say, add 10 years to it, to give yourself a margin of error. The third one would be what kind of portfolio.
Can you hang on just one second? Just one second, because I think there's 2 things. One is you mentioned the fire folks.
Uh-huh.
In just one sentence or two, who are they? And
those are folks. Yeah, sure.
Go ahead.
Financially independent, retire early. That acronym stands for. They basically want to retire much earlier than traditional time.
Got it. And so they cut back spending a lot, and they essentially they have to look ahead maybe half a century, to your point, right?
Yeah.
In their planning.
Yeah, they just engage in a massive savings program when they're younger. Probably up to age 40, 45, and then about that time start thinking about getting out of the workforce.
Okay. And the next thing you mentioned, which is pretty interesting, is that this is kind of a bold decision, which is not to necessarily try to, again, to use your words, optimize to your last breath, take life expectancy plus 10 years and assume that you're going to get that right most of the time. That's a reasonably bold sort of recommendation, I would say.
Yeah. And obviously if your life expectancy is 5 years, you wouldn't have to have 10 years to it. Maybe just,
Sure.
5 or something, but give yourself a margin of error, just like an engineer when they build a bridge. They don't want it falling down on a big wind or an extra load.
Yeah.
Give yourself some room because no one knows what the future brings, for sure.
Got it. Okay.
Okay, the next element, leaving a legacy to heirs, the 4% rule, which is now the 4.7% rule, I should add. I've upgraded it over the last 30 years of my research. That rule assumes that at the end of 30 years, your money will be completely exhausted. But what if you want to leave some of your investment accounts to heirs? Leave them a legacy. You can calculate the effect of various legacy sizes on your withdrawal rate. Obviously, the more money that you want to give folks at the end of your life, the less you're going to have to be able to take out during your lifetime. So there's a balance that you have to address consciously, make a conscious decision. The fifth element is asset allocation, which is a huge topic. I have a very large section in the book about it. And the two primary decisions you have to make: do you want to have a fixed asset allocation during retirement, where you have a certain percentage in stocks and bonds and cash, and keep that and rebalance to that every year? Or do you want to have some kind of a program where your asset allocation may vary? There are suggested programs, for example, where you have a upscale starting with a lower allocation of stocks, and you gradually increase stocks over time. And I demonstrate in the book that actually slightly increases withdrawal rates. So that's worth considering. And there are other schemes that, vary asset allocation during retirement. But that's a big decision that has to be made up front to customize your plan. And we're getting there. Another one is portfolio rebalancing.
Is this number 6?
That's number 6, is portfolio rebalancing. And, if diversification is the first free lunch for investors, where they can get higher withdrawal rates without taking risk, portfolio balancing is another one. I study that in my book, and I show you for the most part it's not a big issue, although in some situations you could have gone all through retirement without balancing and earned the highest withdrawal rate. Kind of strange. But in general, it seems to me about 1 year, 6 months to a year seems to be about an optimum period for you to bring your portfolio back to its original allocation if you're dealing with a fixed allocation. Because, stocks grow so fast, they'll take the portfolio over like weeds and have to be trimmed. Number 7, underlying the 4% rule is the assumption that you're going to be using index funds. You're not going to be trying to beat the market. You're going to accept whatever the market gives you. And generally, that's been pretty good. That's why we have withdrawal rates as high as they are. However, if you're an individual who feels he's talented as Warren Buffett and can beat the market consistently, you can increase your withdrawal rate. And I study that in the book. I also issue a warning. There's two sides to that coin. If you fail to beat the market, you can really damage your retirement seriously by being too aggressive and trying to earn high returns. And the last one is the timing of withdrawals. My research has always assumed that withdrawals be made evenly during the year, like once a month or once a quarter. But in case you're an individual for some reason wants to take all the money out at the beginning of the year, at the end of the year, that makes a significant difference to your withdrawal rate. So those are the 8 elements that you can use to customize your personal withdrawal plan.
Got it. So I'm going to ask a favor. Can we go back over number 4? So
Sure, yeah.
Number 3 was going from the 4.8 to 4.7. And then the next thing I caught was asset allocation. What was number 4? Safari, that was
the fourth element was leaving a legacy to heirs.
Got it. So that was really got it.
Okay.
Got it. All right. Perfect. So in terms of making this work, how is your target audience for this book different than your target audience from your last book?
Yeah, my first book was directed toward fellow professionals. I was an active advisor at the time I wrote it. Now I'm retired, so I'm writing it for other folks like me who are non-professionals anymore and are either in retirement or approaching retirement.
Got it. Do you think that? I mean, this is all great stuff. It's a lot of work for many folks to
Sure.
do all this, to figure all this out. Right. So, I'm curious as you in your travels, even though you basically laid out the roadmap for individuals. I mean, how often are you already talking to advisors that want to show their clients this? So you're talking to individuals. I can still see this being quite useful for both individuals and for advisors. For that reason,
I assume there's a lot. I speak to a lot of non-professionals who are interested in doing this kind of thing. So they're very interested in what I'm writing about. But I suspect most folks probably need a financial advisor to help guide them through this because it's a complex process. And they also, I think, need help with the investing end of things because investing is very subject to emotional swings, and it can be very damaging to your investments if you make the wrong move at the wrong time. So having a objective professional guiding you in that regard, I think, is very helpful.
So it sounds like a lot of the people that you're talking to are sort of sophisticated DIY investors, kind of like some of the people you might see on Bogleheads, right? That are pretty switched on. Like I don't spend a lot of time on that blog, but when I have, I've actually been pretty impressed with how, the thoughtfulness and sophistication of the commentary there.
Well, I think what this book does in laying out so many details is reveal that behind the curtain of the 4% rule is a lot of machinery that you can't ignore. That's one of the purposes of the book. And that you don't want to shortcut and short circuit yourself by picking a number that's been floated around arbitrarily because it may not apply to you at all.
Well, yeah. I mean, and look, it's been fodder for a lot of discussion on this podcast over the last several years. So thank you.
Okay.
Thank you. We've had a lot of opinions here.
Yeah.
But as I led off with, I mean, I think that the key thing is that every conversation about equity investment sooner or later comes around to talking about the S&P 500, right? And discussions around retirement income should have, as part of that discussion, why somebody's taking the position that's a better solution or not, versus the 4% rule. That's so at Alex Income, we just released a research paper earlier this year that we sponsored, and it was by Canex. But one of the comparison points versus our solution of many comparison points was essentially the 4% rule. So I think it's a really, really powerful, really very powerful piece of helping people come to the right set of decisions. So I was going to switch gears a little bit. Bruno, did you have any questions or comments on the 8 rules?
Is there any place in there? I mean, so thinking about the place of annuities in all this, because our show's name is That Annuity Show. So I have to have a plug for annuities. We all know that deferred annuities, fixed deferred annuities, and deferred annuities rates have increased as general market rates have increased. We have now like deferred annuities going all the way up to almost like 6%. So that clearly has an impact on that withdrawal rate that the famous 4% rule. My question is, what about the place for lifetime income when those folks either annuitize and get a stream of income for the rest of their lives, however they get it? What is the place for that in a general withdrawal plan, and how does that impact the actual quote called 4% rule?
Sure. And I should preface my remarks saying that I'm no expert in this area because I really haven't devoted a lot of time to studying annuities in the context of retirement. I've been focusing primarily on, a portfolio containing investments. But I've read the literature, and the literature is very interesting, and it's been around for 25 years. The idea that if you add an annuity into a portfolio, which contains investments, and do a blend, that can actually generate a higher level of income for retirees. And this research is done by people who I highly respect. Everybody from Wade Fowle, Bob Veers published a paper back in 2001. There's been some recent works. So, I really think it's really outside my sphere of expertise, but I really think as a retiree, they should consider at the beginning having the benefits of having at least a portion of their assets in an annuity to complement their investments, because it appears to offer long-term benefits in their retirement.
Well, thank you for that. we're obviously that's obviously something that we focus a lot on in discussing here. But at the end of the day, one of the sort of benefits of sort of the philosophy of the show is that we want to get all perspectives, including any number of people that aren't necessarily as big fans of annuities. And I think it's been fodder for fantastic conversation. So Bill, talk a little bit about what your plans are for this book. So you're already talking about it a lot. You're posting.
Yeah.
Thank you for coming on this podcast. I know I've seen you on other podcasts. Are you going to be doing a book tour? How do you anticipate marketing the latest?
Yeah. Did you ever watch the show? Ever watch the show Castle? The guy was an author, a mystery author, and he did book tours, and that was my dream when I became a published author to go out and visit the cities and sit down and sign books. But apparently the book business doesn't work that way anymore. In our digital age, social media is the primary means of publicity. So I may try to set up sessions with local bookstores, which would be kind of fun, but I'm not going to do those, barnstorming tours around the country, with books. That's apparently in the past. But my plan for the book is to sell 6 million copies. That's not. No,
all right.
Just kidding.
Think big.
No, it's an interesting experience, to deal with a major publisher who have all the resources to do stuff that I didn't have with my first book. So I'm hopeful that it does well, and I hope it helps people.
We have no doubt that it will. So why don't we talk a little bit about what sort of keeps you going in the space? So you're retired from being a financial advisor.
Yeah.
You continue to write. Do you think you'll write another book after this one? I mean, this may sort of complete the loop, right? I mean, I think you've kind of covered everything, but I think it's the reason I ask is I think it's a really, really important template, like to sort of stay mission oriented in what is theoretically retirement. I think it's a valuable template.
Yeah, I plan to keep the book updated because I have a list of research topics that never expires. There's always new things appearing and things rising to the top. So the time, another 3, 4, 5 years, I'll probably have enough, to expand that book considerably. But the basic framework is there, for creating a plan, which I finally was able to create. Can we talk for a second about, the role that inflation and market valuation plays in selecting?
Absolutely.
Okay, good.
Yeah, for sure.
This
is your time to shine. So please, bring in anything we've missed.
Okay,
we'd love to hear it. Yeah.
Once you've customized your plan and developed values for the 8 elements, the next thing you want to get to is your number. What is it? Is it 4%, 5%, whatever?
Yeah.
And for many years, I was aware, due to the work of Michael Kitces, that there was a correlation between stock market valuation and withdrawal rate. The more expensive the stock market is, the lower your withdrawal rate would be historically. And the cheaper the stock market was, the higher withdrawal rate would be. And that makes sense because we know that a big bear stock market early in retirement causes your withdrawal rate to be reduced substantially because your portfolio gets hits early, and it really damages the compounding effect. But the correlation just wasn't strong enough to use it as a tool to access all those wonderful, juicy, high rates from the past. And then about 3 summers ago, I was sitting at this desk and it just hit me. I know inflation's important because in the 1960s, the period of high inflation, that's where the 4% rule originally had come from. I just for years couldn't figure out a way how to quantify it. Then I realized, I thought, and I said, rather putting the stock bear market first, I'm going to put inflation as the most important factor. And within it, look at stock market valuation. The minute I did that, the thing just opened up and I was able to create a system. I have charts and tables where you can look up whatever the market PE is and find your withdrawal rate, essentially, within a particular inflation regime. What I call an inflation regime, low, moderate, high inflation. inflation is very important. It's the greatest enemy of retirees. And it's important that we have, moderate to low inflation during retirement if we're going to have a successful one. Otherwise, it's going to be a struggle for all of us. So once I did that, I was able to develop a complete approach to recommending a withdrawal rate. And it's a neat system. The pieces all kind of fit together. And it's
so the elements are inflation, PE.
Yeah.
And you have that in the chart that allows you to sort of correlate that with the right withdrawal rate.
Yeah, it's just inflation, the stock market valuation, kind of a two-factor model, if you would.
Yeah. Got it. Okay.
Pick it out. And it works pretty well. It's about 85% reliable. And the other 15% is where during retirement you're going to have to make adjustments. And they may, either way, there may be times, like a lot of retirees in the late 80s, were retiring through a time of decent stock market valuations. And their withdrawal rates were a lot higher than my method would have predicted because, if you recall, the stock market zoomed for many years and got to crazy valuations. So they had a huge tailwind behind them because of that huge bear market, which was driven primarily by rising stock market valuations, not rising corporate profits. Who could predict that, at their retirement, years before? So they're a case where during retirement, they would have been justified increasing their withdrawal rate from the initial estimate we had. Other folks might have to take a cut if they run into unexpected high inflation, which is the great enemy.
So go ahead, Bruno.
My question was: have things changed in your way of analyzing and looking at things in this new recent environment? And I say recent, looking at maybe a century worth of data, where you have a lot of concentration within, the top S&P companies. The big tech companies are now, a significant portion of the S&P, which is kind of the benchmark of a diversified portfolio.
Yeah.
But this diversification may not be as diverse as it appears.
Yep.
Does that change your view, your analysis, and how do you factor that into your framework?
Sure. I'm at a disadvantage slightly to folks who use mathematical techniques, to analyze this, Monte Carlo and so forth, because I'm using history. And historically, there are only a few data points available where we've been at this very high stock market valuation and this level of inflation. And that was basically in the late 80s, early 90s, where what I used is Shiller PE, typically is used for the S&P 500, was around 40, which is not far from today. And when I look at that, people who retired in that period of time, let's say in the year 2000, their withdrawal rate appears to be going to be somewhere around 5.25%, maybe 5.5%, which is a lot less than 7% average, but still a lot better than the 4.7%, that would be the worst case. So for the last 25 years, we've been in a period of time because of high stock valuations where we've had subpar withdrawal rates. Instead of averaging 7%, it's barely made 6%. There was only one time, you remember at the end of that terrible bear market in early 2009, when the market bottomed, it was very cheap. So it had cheap stock market valuations and low inflation. And I calculate that retiree would be able to handle 8% withdrawal rate. But that is the only high withdrawal rate in the last 25 years, But it shows you what's possible when we get back to a more normal situation of valuation.
Well, there was a personal finance commentator who sometime in the last year or two, I think, recommended a 12% withdrawal rate. Put all money in equities and a 12% withdrawal rate. I won't say his name, but it's a great name. It's better as a first name than a last name. Yeah.
Yeah, I'm familiar with that. And I actually think he recommended an 8% withdrawal rate because of the 12% returns on stocks, something like that.
Ah, okay. Well, thank you for correcting me because I don't want to, I certainly wouldn't want to mischaracterize.
But it's not, okay. Based on his history, I can't see any justification for that in the current environment. There have been times in the past, obviously, where 8% will apply, like in early 2009. But in 2025, I think the best we can do right now is about 5.25%, and I hope that's good enough.
Got it. Okay. All right. Well, look, I think we're coming up on time. Bill, I'm going to ask you again. Is there anything else that that we missed or should be said from this great work you've been doing? And that's the first thing. And the second thing is, want to know when and where people can find your book, or if they want to reach out to you, the best way to do that.
Sure. Getting the second one off quickly, any online bookseller, Amazon, Barnes & Noble, Books A Million, Powell Books, they all have pre-orders available if you want to pre-order the book at this time. With respect to the first part of your question, I have 5 case studies in my book which analyze managing your plan during retirement. And each one features a different kind of a problem and how to deal with it. And just quickly, I want to summarize. If you run into an unexpected bear market that isn't too bad early in retirement, maybe a 35% or something, not one of these monster 50 or 60%ers, you're going to temporarily look pretty bad against your expected performance, because your portfolio value is going to drop and your withdrawal rate is going to shoot up. My analysis indicates your best management take there is to do nothing, believe it or not, because the stock market will eventually recover and that'll bring your portfolio back and you'll be just fine. Once again, that doesn't apply to a monster bear market, which you may have to take some measures. On the other side of the coin, if you encounter high inflation early in retirement, and it looks like it's going to be a sustained problem, it's probably time to panic. Really, there's no time to do that. When it comes to inflation, the sooner you cut back and the deeper you cut back, the more likely you'll succeed to retirement. And it can be very painful to do that. Not many people can take a 20, 25%, 30% hit in their income from their investments and maintain their original lifestyle. But that may be necessary to keep going. Sure. That's why I label inflation as our worst enemy. It could be devastating for retirees.
All right. Bruno, any parting thoughts?
No, thank you so much for coming. And to your point, Ramsey, we love to hear all sides. We want to hear all points of views, and that's clearly a critical one and a well recognized one in the industry. So thanks, Bill, for coming.
My pleasure. Enjoyed it. Thank you for inviting me.
Sure. Well, Bill, thanks for coming back again, and we look forward to having everybody in the audience back for the next episode. Please give us feedback through the various channels, and we look forward to having our lead host Paul back on the show next time around. And with that, see you on next That Annuity Show. Thank you. Bye.
Nassau Financial Group is always working harder to be your carrier of choice. We build products that help protect people's savings and are dedicated to providing you with best-in-class service. We seek to keep things simple and have your back in the years to come. Nassau is headquartered in Hartford, Connecticut. Learn more at nfg.com.
Zinnia, an Eldridge Industries business, simplifies insurance. It delivers comprehensive solutions for the industry's most critical needs and creates the modern rails of the insurance industry. To learn more about Zinnia, please visit zinnia.com.